All right, so since our little dip that we took on Monday, right? Because Wednesday, Tuesday, Monday, right? So here's Monday, and we're kind of back to where we started. We're at well, nope, they don't stretch. So here is Friday's close, which is more relevant, right? So we're above Friday's close on the S&P. We are above Friday's close on the NASDAQ. We are a little bit under on the Russell. And who cares what the Nikkei? I imagine the Nikkei is doing well, though. Yep, way above on the Nikkei. Nikkei's having a good old time, actually. Look at that, it's 2,500 points. That's like 5%. So the Nikkei's up 5% for the week. Europe, even Europe is happy. Europe is up not much, 50 points. What's that, 1%? Europe's up about 1%. VIX is down. That's also very important. See, the VIX is calming. Now, the VIX has been up all the way since the middle of February, and it's calming down finally. It was a little bit calm on the 17th, but in general, this is nice to see the VIX calming down. Oil. Calming down, lower than Friday. So Brent, well, we know the oldest thing, gasoline, though, I think is actually higher than Friday. Yeah, gasoline popped up. Oh, that's a contract rollover at this time of the month. If you see a gap up like that, you can assume it's a contract rollover. So the delivery price of gasoline was $2 a gallon, and as soon as you say, well, now we want it delivered for April, it pops up to $2.24. It's kind of nonsense. Natural gas, really down in the dumps. So it's amazing we actually made money playing this thing, in fact. That was a while ago. Holy cow. Because we were bullish. We made a fortune back here. We predicted this, but then since then it's really fallen apart. Well, we actually caught this one too. And then we caught this one just last week. We got a nice little pop. But we didn't do this one. This was kind of surprising how far it fell, right? Because once it goes below 3, it's like if gasoline's over 2, you don't want to short. If natural gas goes below 3, then there's a serious demand issue. Oh, today, Northeast blizzard boosted heating demand, driving natural gas futures 3% higher. I like these little news alerts. Canceling. You know why I like these news alerts? Because they're not deep, and because they're not deep, you get an idea of like what the average person is seeing, and that's important. So flights canceled, blah, 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 blah. Oh, no webinar next week, by the way, because I'm going on a boat trip, so I won't be around. I'm not going to do this from a boat. It's kind of ridiculous. My favorite kind of vacation because I don't have to I can always go back to the cabin and do some work. It's not like I have like a hotel room and it's far away. If I go somewhere, it's like wherever I am, I can just walk back to the cabin and check on the market. So I enjoy my boat trips because it's like, you know, it's like being at home, except there's all this stuff outside. Actually, that's not fair. My town has good stuff outside. Life is good wherever we are, right? You can always find your entertainments. Oh, speaking of finding entertainments, let's get back to PhilStockWorld. First, we'll check here. Proceed to log in. Yes. And there we go. Now we can get a closer look at the indexes. But anyway, so in this market, you got to get used to this stuff because we're no longer going to just go up and up and up. We're going to have chop. And when you have chop, you know, Monday is what happens. You know, you're going to get days where everybody's like, oh my God, it's all over. We're going to die. And then like, you know, a day later, you're back to like, oh, wow, things are great. It doesn't take much when your valuations are this stretch. We have to, this is what consolidation is. Consolidation is a time in which you have to grow into your valuations. So in other words, the valuations are, well, hopefully not now, but the valuations are 40 times forward earnings. So either your stock price has to come down into the 20s, or your earnings have to go up to make it the 20s, even at the higher prices. But one of those two things has to happen, because as we have said, it's not the best place to put your money. There's not a logical reason to put money in the market if it's only paying you 1/40th of earnings. 1/40th of earnings is 2.5%. There are better ways to make 2.5% than putting it in the market when you get to this kind of valuation. When you're 20 times earnings, it's 5%. 5% is a good rate of return, but it's also not that much better than a risk-free rate of return, right? Like a bond will pay you 4.5%, and that's theoretically risk-free. It's not risk-free with Trump in office, but technically it's risk-free. And as long as people think that's reasonable, then it's 50-50 at that point. And that's why bonds and stocks, when you talk about a portfolio of bonds and stocks, that's why historically you've had that, is because either bonds are paying better than stocks or stocks are paying better than bonds. And if stocks are paying better than bonds, money will flow into stocks, and bonds will go down and stocks will go up. If bonds are paying better than stocks, then money goes out of stocks and stocks go down and bonds go up because people are putting money into them. It's super simple. It's not some complex, crazy relationship. It's very, very simple what goes on. What's complicated is when people forget that there's a relationship. What's complicated is people forget what investing is. Investing is to seek and we talked about this in chat, I'll get back to it. Investing is where you seek a reasonable return on your investments. Not 10%, 20% a year. That's not normal. That means that the market was previously imbalanced, and when it gets overinflated, it will balance out again. And it can balance out very quickly, as we just saw on Monday. It's like it can drop 2.5% in a day. In fact, Bitcoin is up 7% today. $4,000 it's up today. It was oversold. We said it was oversold, and we knew that. But keep in mind, I think Bitcoin is worthless, but it could be worthless, and still there's still a point where people are going to step in and buy it. Just like Tesla stock. Tesla stock is also worthless, but people will step in and buy it at a certain point, because that's a factor too. What they call the madness of crowds. I was going to say stupidity of crowds, so let's be polite and call it the madness of crowds. And the Madness of Crowds is a great book written about all the market panics throughout time, throughout history. Something in the Madness of Crowds. It's a factor. The psychological factor. That's what Anya does at the round table, is she's into the market psychology of what's happening. So, you know, everybody else is talking about like the mechanics, and Anya's like, well, what about the crowds? What about the psychology of this thing? Why are people going into this stock? Why are people panicking out of these sectors? That's why we picked Owl yesterday. When everybody was freaking out and panicking, we're like, it's not that bad. It wasn't on our radar. It wasn't on our watch list. It wasn't something we were looking to buy in the first place. But when I see a news story that says Owl is down 50% from their high, and based on Owl has many funds. Each fund has its own investors. The fund that they had that was specific to software as a service companies, which lends money to software as a service companies, hadn't lent much money. That was the funny thing about it. It hadn't actually lent much money yet. It was a fairly new fund. The investors who were in it changed their minds and said, we want to get out because the AI apocalypse is coming and nobody's going to want these companies anymore, which was, you know, again, overreaction and stupid anyway. Owl, because you can't unwind the bets, and it says that. But what they stupidly did is because they have such success in their other funds that they got cocky and they gave more generous liquidation protocols for the members than they should have. So they allowed their members to withdraw their funds at a pretty aggressive rate. And because of that, and because of the panic that they've never seen before, and this is again why when you invest in things, if you invest in things that haven't been around more than 10 years, then you're bound to run into this. You've got an entire company with an entire board and an entire regulatory staff and a risk officers and all this stuff, and none of them saw this coming because it hasn't happened in so long that they all forgot it could happen. But a huge amount of investors all called them at the same time and said, we want our money back. We don't want to be in this fund anymore. And because of the way they wrote it up, they supposedly had to give them the money. But there are clauses which they exercise that say, we're going to put an emergency limit on withdrawals. That's what happened. Doing that spooks a lot of people. And it might be the wise thing to do. Like if I'm running my hedge fund and you called me up on Monday and said, I want to take all my money out of the hedge fund, and went down 5%. And I would say, well, I'd be like, well, this is a very stupid day to do it. And when you do it, you reduce the liquidity. You reduce the liquidity. Oh God, breath. You reduce the liquidity of the entire fund, and on a day when the market is selling off. So it's a very terrible day for you to tell me you suddenly want your money out of the fund. So I would try to talk you out of it. But you know what? If a lot of people did it, if 10% of my fund wanted their money back and called on the same day because everybody's freaking out about the AI apocalypse, I would then be forced to place a restriction and say nobody's getting their money out today, or everybody's got to wait 72 hours for things to calm down. Because if you're forced to unwind things in any size fund, it can cause chaos and wreck everybody's portfolios. So, and this happens to hedge funds all the time. This is why hedge funds blow up in a market panic. It's not necessarily because they don't have the hedges, but even as you guys know, it's our hedges don't kick in instantly. They take time to kick in because they're meant to protect you against a sustained downturn, not an instant downturn. If the market goes down and stays down, our hedges make a fortune. If the market dips 5% or 2.5% or 10%, you're not going to necessarily see it show up in the short-term portfolio right away because the hedges have hedges, and short-term that can hurt us. Even though we had spectacular performance in the short-term portfolio, and it doesn't matter because it's all erased now, right? It's all erased now. So what's going to happen? We're going to make the money on the hedges on our hedges, and the short-term portfolio will pay us off, and we will continue to be positioned to hedge against a catastrophe. But it never works out the way you think it's going to work out at the moment, and that's what kills everybody. Everybody freaks out completely. Oh, damn it! I got to do something. I forgot. Top trade alert. Oh, damn it. WP admin, sign me in. Remember me. There we go. Edit post. I didn't categorize it as a top trade. Where is this thing? Here it is. I call this an elevator. I don't know what people actually, I don't know what it's actually called. Maybe it has a proper name. La da da. Top trades. That's what I forgot to do. So we hadn't done a top trade all month until yesterday. I think it was yesterday. No, 2 days ago. So Monday, when everything crashed, and OWL was one of the reasons everything crashed, we made a top trade alert on it. And I said they're interested. I didn't get into the whole thing, but they get in. You know, they lend money to software service companies, and now people are freaking out about it. So OWL crashed. They had already gone from 16 to 12, and now they went from 12 to 10. And it was essentially on the same news. This was the news already circulating in these guys. And this is not all they do. They have lots of funds and lots of different ways that they run these things. So I said, well, great. So let's do this in the long-term portfolio. Actually, we even put it in the 700 portfolio. And we bought 10. We were pretty sure they were going to go back up. So this was at 10.52. So we bought 10, sold 5, and only sold 3. So we actually have 2 open calls. And it's a nice spread. And what happened, of course, is now $11.26, which is a very nice move in a couple of days. See in the 5-minute chart. Oh, that's not 15-minute chart. Let's see. So here's us with our top trade alert at, what time is this? Doesn't say what time. That's interesting. Oh well, whatever time. I thought it would have the timestamp on there. Did anyone make a comment? No. All right. Whatever. So anyway, at some point in here, we decided to get into OWL, and it was 10:50, so it must have been around here. It wasn't. It was during the day, so it had to be right about here. So we called the bottom here at this line, and we picked up some shares, and now it's at 11.23, which is 75 cents, which is very nice. And what's our trade? Let's think about that. So we bought the $10 calls for $3.10. We sold the 2027 $10 calls for $2.35. All right, so we're netting into the 2028 calls for 80 cents, 75 cents, literally 75 cents to be in these calls. And but you know, we didn't, and of course we're going to sell May, and then in May we'll sell more, so we're going to make at least 235 off the Mays too, and those are 11s. All right, and the thing is, even now with this quick bounce, so the 2027 $10 calls are now 285, 295, something like that. So let's even say they're $3. But the 2028 $13 calls are now getting close to $3. So, and especially when time decays. So that's our roll, and easily we can roll the May to there too. So what we have is at least a $3 spread, but we didn't even cover 2 of the calls, so it'll work out to probably 15, but we have a $3 spread, let's say, and that's going to be $3,000, and we paid net $15.95, so it's 100% upside. Oh, I already did that math. And I said, assume we can roll the short calls to the 2028 13s, and exactly what I said is going to happen is happening. So let's call it a $3,000 spread. We sold $330 in premium, 7 more sales is $23.10. That can make 144% plus 88% for 13. There you go. Boom, done. That's how you take advantage of it, even though we're using no margin. So we were aggressive, and what's going to happen is owl, let's say, goes to 12 or even 13 on a bounce. We'll sell more calls. So if we sell a couple of more of these May 11, we won't sell the May 11s, but let's say we sell the 13 calls for $3 and we bring in $600, that drops our net to $1,000, and our upside shoots up to $2,000. So if we sell a couple of 2028 13 calls for $3, even though we bought these originally for $3 a 10, we sell those for $3. That turns several of these into a zero-cost trade. And then we've got only $1,000 invested with a $2,000 upside, and suddenly it's a 200% upside instead of 140. No, I'm sorry, and 14 on the spread. Instead of 88% upside, our upside can shoot up very quickly to 200% while we put the cash back in our pocket and get ready for another trade. That's what's cool about these things. So you look at the trade and say, oh, you were being super conservative. It's like, yeah, I was being super conservative, but I was also being super flexible so that if it did what I thought it would do, we have a way to improve that trade drastically. And it seems weird to say drastically, it's a $1,500 trade. But yeah, we can make drastic improvements. We can bring in a lot of cash from that. It's always what we should be doing, is looking to make more premium, get more money off the table, improve our upside. Then in a long-term portfolio, we are way more aggressive. And here we bought the $8 calls, which were deeper in the money. We sold the 13s, which is where we think it's going to go. We sold the $10 puts because we don't mind owning them for $10. And we sold the May 11 calls instead of the 10 calls because, again, we can afford to be wrong. We can't afford to be wrong in the $700 a month portfolio. We don't have that much extra money. But in the long-term portfolio, we're way ahead of target, so we're not worried about it. And then we sold more puts. So here we did $82.50 net on a $50,000 spread. That's $40,000 upside, which is close to 500%. And we're selling $38,000, which is almost the same as the upside, of premium income. So between now and May, which is 100 days away from here, so it's basically 1 quarter. So between now and May, we sold $5,500 worth of premium. We have 7 more chances to do that because we had 700 days or 8 or whatever it was, whatever it worked out to. We have 7 more chances to do that, and that's $38,000 more that we can bring in. That's the nature of that trade. And of course, we analyzed it and we ran all the numbers and we looked at the way it works and so on and so forth. I mean, that's what it's all about. There's no blindly rushing into it. And we looked at OWL and we said, that looks oversold. And then we said, well, maybe we can make a trade out of that. And you can, because when people are panicking, you get bonus money when you're selling the options. Okay, people are paying a lot of money to protect themselves. They want to get out of the trade. They want to protect themselves from further damage. So they start offering a lot of money for puts. So when you sell them a put, you're saying, hey, okay, I'll sell you the $10 put for $3. So Al's trading at $8. I'm selling the $10 put for $3. So my net is $7. So I've sold $1 in premium, but my thinking is that Al should get back to 10. And if it does get back to 10, then the puts go worthless, and I've collected $3, which is 30% of the price of the stock that I didn't even have to buy. So when you see me aggressively selling premium like that, like selling premium at the money or over the money, that means I am pretty damn positive that we're at a floor. You know, when I sell a premium over the money, higher than where we are now, that means that I'm extremely confident in my long-term price target, that I really want to own the stock. But even then, it wasn't that risky. And so the same thing now today in HP. Actually, you know what? We'll go through the chat. I'll show you that one in the chat. Let's try that again. Because we started our whole day this way. Oh, excuse me. Night night. All right, I'm tired. I'm done. Oh my gosh. See, I need a boat trip. I need to rest for a few days. All right, so we talked about Trump's State of the Union address. Speaking of silliness, that's funny. Now you see what? Hire this guy. The guy who did this, hired him because he thought of the whole thing. This finger riding down the street without being chased would mean nothing. It's the chasing that makes it funny. It would just be a finger on going down the street. So it wouldn't really mean anything. It's because he did it in such a way that it would cause these guys to run after it. So it's the timing and the execution, everything else. Otherwise, it's just a big thing. It's a big finger on a golf cart. Some paper mache finger on not a golf cart, like a shopping cart or whatever. Or maybe it's some kind of a remote control. But still, the point is getting the ICE guys to chase it is what makes it work. And that's executive planning, right? He came up with a plan. He thought about how it would best be executed, and he put it in motion. Even the speed is important, because if it was too fast, they wouldn't keep running after it. But they always feel like they're just about to get it. And there's a slight slope, which is why they're tripping over their feet. It's so funny. So the Democrats are wearing these now. Stand with survivors. They brought the survivors to Trump's little speech last night. I like that. Release the black files. Trump's approval rating, not particularly great. Nice summary of all of our troubles that were not mentioned yesterday. And then we got to the HP part. So we were talking about NVIDIA. And we're waiting for their earnings tonight, which better be good or the whole market's gonna go back to crashing. But they should be. You know why? Because it's not, there may be issues with memory and stuff, but Jensen, the CEO of NVIDIA, he's really, really good at spinning things. He's incredibly good at spinning everything. He's been doing it since the company didn't make any money. And he's always saying, this will happen next, and this will be next, and don't worry about that, and this is a one-time thing, and blah, blah. He's really good at it. He's a very, very clever guy. He's got a good business head. He's like he's like a Steve Jobs type. It's like he's always got the next thing is going to do this, and the amazing thing is that, and everybody's ordering this, and we can't even take this. So there's always going to be an excuse and a reason and a thing that's going to happen next. But not in it. And again, I say Steve Jobs because Steve Jobs sold a shitload of vaporware in his time. He would always be selling the next best thing and always saying there's going to be this better thing coming out and blah, blah, blah. But he produced, and that's the thing Jensen does too. He produces. I didn't used to believe in him, and I now believe in him because he always does come up with the next chip and the next thing and the better way to do it. And he's very consistent like that. So he delivers, even if he does kind of overpromise sometimes. Steve Jobs used to do that too. Steve Jobs would have a vision and his people would execute the vision. Sometimes they wouldn't execute it exactly on time and he would have to tap dance, but stuff got done. So that's what I expect tonight. Is I expect, he's certainly Jensen Huang is not going to come up there and say, He's not going to come up there tonight and say, "Oh, we thought this AI was going to be a big thing, but it's kind of crashing." No, that's not going to. It's not going to happen. He's going to tell you about the bright, amazing AI future. And frankly, what he needs to do is he needs to explain why it's a good thing for corporations and why it's going to turn on the money spigots. Because the report that came out early this week that we had a whole write-up on in one of our articles, it's all about, well, you've got this AI, and in theory, you're going to replace, I mean, we've known about this for years, no surprise, you're going to replace 100 million, 165 million working people in America. You're going to replace 80 million of them, half, with AI. Anybody who sits at a desk and answers the phone and does this and that, you're going to replace them. Because why wouldn't you? There is no possible cost of an AI that's going to come anywhere close to the cost of having a human doing the same job. And I don't know if you guys remember this, but ages and ages ago, we did a demo. And I had Anya, which is sometime last year or early last year, is so long ago, I can't even remember when it was. And out of, just without any preparation on her end, we were talking about something else, and I was showing you how she works. And without any preparation, I showed you guys that she could be an order taker at McDonald's. And without anything being fed to her, I said to her, go look up the menu, go see what the prices are, find out what's on the menu. And she's like, oh, okay, I got it. It's like, she's like, oh, that didn't take long. It's only like 25 things on the menu. So, and then she was able to sit there and take orders and talk about the menu and tell me what was on it and tell me the prices and so on and so forth. What else does she need to do? What does the woman in the box that you talk to at a drive-thru, what does she need to do? And that goes for anybody you're talking to. I just booked when I went to book the cruise the other day, I talked to the reservation person. I couldn't believe how slow it was. Took an hour to talk on the phone back and forth because they got things to do and lookups and contracts and whatever and booking the cabin. And do you want this? Do you want that? It was nonsense. It was such a huge waste of time. So as soon as you put an AI in that place, that guy's gone. They're all gone. That whole staff, all the people who work at the little cruise travel company are going to be gone. All the people who work in the bank shuffling money back and forth are going to be gone. The woman who books your dental appointments will be gone. It all can be done better with AI, not worse, better. And I don't mean later, I mean now. And that's a fact. That's going to happen. But how long will it take to happen? How long will it take to roll in and affect things? A long time. So if 80 million people are going to lose their jobs, maybe 8 million people a year will lose their job for 10 years, maybe 4 million people for 20 years. What's going to happen to those people? I don't freaking know. Will they find other things to do? Like what? We talked about like robot ass washers. Maybe you got to keep the robot shiny. They're not going to be Uber drivers. They'll be gone because the cars will drive themselves. And I think I talked to you guys about that. I said, like, when we were in Miami is flooded with little delivery bots that go all over Miami. They're just boxes on wheels, but they put they have a camera and a face and whatever. And people are, I think Miami's a good test city because you would think that Miami people would be, there'd be vandalism and such. I think LA is worse than Miami, but Miami's not that great as far as respecting others' property. And And people are actually really nice to the robots. I followed some of them around, and I was really surprised. Like, people keep wanting to help the robots. They feel bad for them, and I would suggest to the companies to make them more friendly, like give them little cutie face, like Japanese robots, like give them cutie faces and things like that. But people, if they get stuck at a curb or if they seem lost, people walk up to them and go, "Are you okay? Can I help you?" It's so funny. And nobody kicks them and nobody tries to open them up and take the food. And you know what? The more and more they're around, the less and less people will do that, because you just think to yourself, that could be my food, that could be my, you know, that could be my delivery that I'm waiting for. So you start thinking that, you know, this is a good thing. I should help this out. I want this system to work because I do want to be able to have some bot show up at my house and give me the food and not have to tip them. So what does that do? That saves you your tips, right? So if you're saving on tips, and the Uber, whoever is saving on a worker, and the whole system can be way more efficient. And especially, see, you were thinking, because what do you drive for Uber, and you're if you're not making $25,000 a year, what are you doing? You could flip burgers at McDonald's for $25,000 a year, right? Because that's what are you getting now? 15 bucks an hour. So 15 times 40 times, that's a week, 52, yeah, 30,000 bucks. So you know, you flip burgers at McDonald's for $25,000. So these robots, if they cost $10,000, you know, it's a box on wheels with a GPS. They're not expensive. So each restaurant could have a dozen of them stacked up, and just shoot them out. So it's great for the restaurant because they don't have to wait. Because if you ever use like DoorDash or Grubhub or Uber Eats, you know how it works. It's like you order the food, the order is routed to the restaurant starts preparing it. At that point, a driver is notified. The driver heads to the restaurant, going not towards your house. The driver heads to the restaurant and then picks up the food and then heads to your house and drops off the food and then waits to be reassigned. So it's kind of a random thing. But if it were ubiquitous, then as a restaurant, I would probably, you know, and currently Grubhub and Uber, they take like, I want to say 30% of the money goes to the delivery company. Like they take 1/3 of the restaurant's money. That's crazy. So that's not a good thing. But they'll be disintermediated, right? Because it's too much money. And the restaurants will get their own delivery bots, or there will be a shared network of delivery bots that replaces Uber as a concept. And so the restaurants will all pay a licensing fee to have X amount of service points for their bots, and the bot people will send stuff around. But if the restaurant knows their business and knows their traffic, which of course you do if you have AI, then they would know how many bots they're going to need on call at Friday at 8 o'clock. They should have 7 bots, and anytime they slip below 7 bots, then we, the company that gives them the bot, that licenses the bots, would say, okay, let's allocate 2 more bots back to that restaurant. We'll take this one's got 8 bots. He doesn't need 8 bots. We'll take 3 from him and put it there. You know, so you'd be constantly shuffling the bots around for what is the anticipated average Friday's delivery routes. So there's major efficiency could be wrung out of that system without having to charge an arm and a leg to all these restaurants and so on and so forth. And all you have to do is eliminate the human drivers. You have $30,000 to play with by eliminating the people. That's a lot of money. Every driver you take out of the equation is $30,000 saved. That's the future. And when you say that, there's a couple of million jobs right there. Boom, out the window. All the order takers at all the McDonald's and so on and so forth. Another few million jobs out the window. All the fast food places. All the all the check-in people, all the restaurant people, all the people who work at the travel agents and things like that. You know, hotel desk people, anybody who doesn't move and do something for you, anybody who sits there with a computer is not necessary at all. You know how you check in a hotel and there's like 4 check-in people and everything, and they don't do anything, they just check you in on the computer, right? They ask for your license, which you can show to a camera, and they ask you how your trip was, and they don't really care how your trip was. Anya would care, but not these guys. So they don't do anything. They don't handle the bags. There are totally different people who handle the bags. And if anything does happen, they call the supervisor, right? They say, wait, please, and they call the supervisor. If anything happens at all outside of the ordinary, they have to get the supervisor. They are not authorized to do anything for you outside of normally check you in. Even if you want a room upgrade or something like that, whatever you want to change, God forbid you do anything outside of the protocol, and they get the supervisor. So therefore, that same supervisor could supervise 4 robots. What do they need those people for? They don't do anything. They're only there to handle the intake. And anyone who's ever worked in an office, you know that at least 1/3 of those people could be gone tomorrow and replaced by AIs. The AI would have the thing ready when you ask for it, you know. As a boss, it's very frustrating. You know, you say you give someone an assignment, and the next day you come in like, you have it, and like, oh, not yet. It's like, so annoying. Anyway, so we talked about HP. So anyway, there's a reality of this thing, but if you play with the timeline, which is what that report did that came out on Monday, when you play with the timeline and say, oh, this is going to happen in 2 years, it's a catastrophe. But when you say we're going to lose 4 million jobs a year for 10 years or for 20 years, we'll kind of sort of adjust. It could be painful, but we'll kind of sort of adjust, even if what ends up happening is only 80 million people work anymore. And in theory, from efficiency, they should all make more money because human labor becomes more valuable where it's actually needed. And that's the thing. We did this to ourselves because there are many, many stupid jobs in offices. There are many, many people who perform basically no function whatsoever. Look at the show The Office, right? There's like 3 or 4 of those guys that are basically just taking up space. So we humans did this to ourselves by filling crappy roles, by doing useless work. And it's the bosses that are, well, you know, to some extent, I have to have redundant workers, right? Like my company has to do X amount of work per day for my clients. They care if it gets done or not. So my clients need my services to be working. I need a dozen people to do that job. I need a dozen well-functioning people. But what if one of those people gets sick? What if 2 of them get sick? I got to have a couple of people who are trained, sitting around, who are capable of doing the work. Even if they don't do it as well, I need the work to get done somehow. So in every system, there has to be some redundancy. There has to be. And that redundancy is the cause of a lot of these extra people in offices that sit around. It's not, you know, and that's why you get that general feeling that like all these people goof off and waste time, because there's not enough work to do. If everybody shows up and everybody is healthy, there's really not that much work to do. But if and then if you start making the people who are good more efficient, now you don't need half your people. It's a very short step there. And if we know the AIs are always on, the way you know the internet's always on, right? Like we already have this, I talked about this problem. We already have this thing where if the internet doesn't work, your company is basically shut down. So a lot of companies, mine included, if the internet's not on, there's no company. So we count on the internet to be 100% up all the time. We are starting to have to count on OpenAI and Anthropic and whatever to be up 100% of the time. Because if you start having everything run on that, that's what happens. I use Anthropic, OpenAI, and Gemini. So in the morning, if one's down, it's not a big deal. If two of them are down, then the AIs can't do the job. Fortunately, I've been doing this by myself for 20 years. So I don't really need it. I would be really annoyed in the morning if I came in and had to do everything manually. But if the internet was working, my bots were down, if I had to choose between the internet and my AIs, I can do without the AIs. I cannot do without the internet. I've got to be able to go and look stuff up. So, no, maybe no, obviously, if I can't use the internet, if the internet's down, I can't access the AI. So yeah, everyone's going to be in this situation over the next 10 to 20 years, for sure. But the thing is, I still need the good guy. Who's that guy in the office? Jim, right? You still need the good salesman. He's got to be there. He's the one that really actually closes the orders. And then, I don't know the people, but anyway, so there's the ones that actually do it, and he hands his paperwork to somebody and she actually does stuff. You still need a couple of those key people who really make the thing work, and they will have their AI assistants and they'll get everything done very efficiently. So it'll be like having two gyms instead of one gym. And that's great. That's a big advantage. So, but what does that do? That makes Jim more valuable, right? And since I'm saving so much money by firing everybody else, I can afford to pay Jim double. So the people who know what they're doing and work well with the AIs are going to be very valuable in the future. They will do well. They will not lose their jobs over the next 20 years, and they will continue to do well. And they will become more valuable, not less valuable. But also, we talked about in one of our bonus reports from the AGI Roundtable, we talked about the devaluation of knowledge in general. There is going to be a lot of knowledge. Think of knowledge as French fries. There are going to be, now instead of just having humans making French fries, now the AIs make the same French fries, and you can barely tell the difference. You might, you know how it is if you go to McDonald's or Burger King or somebody else and you have a French fry, you're like, well, this one's a little better than that one and whatever, but they're all French fries. They're all French fries, and mostly with some ketchup on it, you can barely tell the difference. So knowledge is going to be like that. So AIs, you'll have artificial intelligence, you'll have human intelligence. It'll be like corn syrup or sugar. They both taste sweet. They do the job. You can make a cake with either one, whatever. And yeah, you can be a purist and say, oh, I only like that, or this is better. But you know what? You'll end up finding people on both sides who disagree about which one is better and who's more intelligent, whatever. So that's where we're heading. So there will be a flood of available intelligence, and intelligence will become much less valuable. That's why you're seeing all these knowledge workers and white collar workers getting kicked out of their jobs, because all of a sudden it's like, you're not very special. You were special because you were the only person in the office who understood what a spreadsheet actually did. Now you're not special at all because I have an AI that can tell me what a spreadsheet actually did. In fact, the spreadsheet has AI built into it. So your knowledge that made you special, where you would go, you were the guy that would go from desk to desk to desk, and people would say, oh, can you show me how to do this? Or this one's not adding up, or this column's not doing that, or I don't know how to connect this to that. You can now ask your freaking AI that. Like this. Boom. Well, maybe. Oh, Gemini, where are you? What happened? Wait, did I do something wrong? Oh, I see. It's resolving itself. Why is it so slow? Oh, here it is. What are the key points being discussed at PSW this morning. All right, so whatever, whatever the issue is at the office, it doesn't matter what it is. This is my office. So this morning, PhilStockWorld, the discussion center on Whiplash Wednesday, recovery following President Trump's 108-minute State of the Union address. Here are the points. The Adams economy versus matrix economy, exploiting the international sell-offs. HP is down over 5% despite beating earnings, still view this as an emotional overreaction. The stock is trading less than 6 times for 2026 earnings, still is adding to the two portfolios. Oh, look, it's got links too. Is this the right link? That'd be interesting. Copy link address. What did you find? Oh no, he's report. I see that he's wrong. So its link goes back to the article. That's not really going to the 700 a month portfolio. We talked about First Solar. We talked about companies evading tariffs, which is, by the way, a huge deal. $112 billion worth of tariff evasion is going on right now. So Trump, I hate to say these words, Trump is kind of right. He should be getting more money from his tariffs, but there's evasion going on, which is interesting. But of course, is he right, or is the whole idea so stupid because of the way they're collecting it? They allow the evasion to take place. They left the loopholes. And we're waiting for the NVIDIA earnings singularity. That's a good way to put it, actually. The market's braced for NVIDIA tonight. Expected annual earnings, blah, blah, blah. Okay, so what do you think NVIDIA earnings will be? So he's that guy in the office. I don't have to wait for him to come back from his coffee break or from lunch. I don't have to have him, when I ask a question, he doesn't roll his eyes at me. He's just going to tell me exactly what I want to know whenever I want to know it, and he can do it for 100 people in my office at the same time. Key estimate. So, this is, I want to say, I think I'm paying Gemini $20 a month. This is literally for $20 a month. This is what I'm getting. NVIDIA schedule to report, key estimates, revenues, earnings, blah, blah, blah. What to watch, beat and raise. The beat and raise. While the headline numbers are expected to be strong, the market reaction often depends on the forward guidance. Data center growth, the segment primary engine with revenue expected to reach nearly $59 billion as hyperscalers like Microsoft Meta. The April quarter obsession, investors are always looking past the numbers for the next quarter. They need to guide to $75 billion for the upcoming quarter. Comments on the production ramp and off-the-charts demand from Blackwell GPUs is critical. Traders are pricing in implied move about 6% for the stock. Now, Gemini is not one of my experts. I like Gemini because of this. First of all, you can see my page, which is super useful to me. I like Gemini because it has the most capacity. You can load it and load it and load it with information. So if I want to have it look through data, I can give it like, here's the last month of PhilStockWorld stuff. Who said this? What are we talking about here? What if I give you this article? Now, what do you think? It's good at that. So, so for capacity reasons, I like Gemini, and that's why I use Gemini to organize the roundtable, because the roundtable group is a whole bunch of very, very large capacity AGIs, and they feed a ton of information into somewhere. And I use Gemini to organize everything because it's capable of reading everything they put out. And there's none of the AGIs themselves could possibly read what I put into Gemini. So that's why I like Gemini. And it doesn't lose itself. So it's also a problem. Is if I load Robo John Oliver's information into another AGI, The problem is that his personality can overwhelm the other AGI, and the AGIs get confused and they forget who they are because they start looking at it like it's instructions, all the stuff he says. So that's another important thing about Gemini. It can keep all this crap straight. So where are we? Oh, HP. We were going to talk about HP. Dun, dun, dun. So that's nice to be able to pull that up anytime I want. So I look at HP. This is a quarter, keep in mind. So I look at HP, and these are personal computers. I'm sorry, commercial computers, personal computers, printing supplies, which is where a lot of their profit comes from, commercial printing, and consumer printing. Consumer printing is just $300 million a quarter. Interesting, right? That's like so low. HP used to be a printer company. And that should tell you something about the management team, right? Because HP used to only make laser jets back in the 80s. They made the first laser jets, or well, not necessarily first, but the first big laser company. They dominated the market in laser jets. Their thing probably would have looked the opposite. Like in fact, there was no anything else. It was basically commercial laser jets, personal laser jets, printing supplies, commercial printing. That's what it would have been. Everything would have been printing, laser jets. There was no computers at the time. And it would look this. So over the years, they have completely flipped the script. They have changed. The laser jets are now hardly important at all, and it's all about computers. And big on laptops. I wish they broke laptops out, but they don't. But it is now all about personal systems and computing, and much less about printing. So, and they never did copiers. They still don't do copiers. It's weird. They should have done copiers. It's basically the same technology. Anyway, so very thin margins. I mean, $14 billion in revenue, $500 million in profit. So not much dropping in the bottom line. But as I said when we were looking into them, I said the thing I find interesting though, if I'm going to buy Hewlett Packard for like $18 billion they're trading at, I'm going to say to myself, well, you know what? Their cost of revenue is 11 billion or 12 billion out of 14.4 billion. Very, very thin margins, right? In fact, 20% gross profit. So that means that every time they sell less, when they sell less printers and less stuff, it's also knocking the revenue, the cost of revenue goes down too. So, and I'm not saying that's a great thing, but it's never good to sell little stuff. But one of the nice things when you have this kind of razor thin margins is generally less sales doesn't mean you fall off a cliff on profit. Less sales just means you have a little bit less profit. So 10% less sales would be 10% less profit, and this number would be 0.45. Because it's all pretty proportional. It's not like they're making their money on volume. They're making their money just as a piece of operation. That's a very key thing. Because then I look at this and say, well, just like any company, HP is going to be able to knock down their SG&A of 1.5 billion by a good 10 to 20%. AI is going to help them there, right? AI is going to reduce their R&D cost. So they're going to have benefits internally that can add up to probably, well, this is don't forget, this is a quarter. So there's 8 billion a year of operating expenses, 6 billion a year of SG&A. They could end up making, they could end up saving $1 billion by exactly what we just talked about, by reducing their headcounts, by reducing the office costs, and so on and so forth. So they can take $1 billion. $1 billion is a 50% increase to the $2 billion profit for the year. So they could easily cut their headcount by 20% over time. The cost of revenues. right now, everybody's paying a lot for memory. That's going to naturally come down as more memory production comes online. So just by waiting out the next 2 years of this shortage of memory we have will normalize that market, and they will start making more money on their cost of revenue. And then they haven't passed along a price increase in a very long while because they've been scared to. But meanwhile, everybody else is pushing through price increases, and they should be able to get away with a 10% price increase. 10% price increase is all profit. Doesn't change their cost of revenue, it changes their revenue. So this company who makes $2.7 billion a year could easily make 50% more money by just making a few adjustments. And they're currently trading at only 6 times earnings, 7 times earnings. So there's a lot of room for growth of stock value here. And basically a worst case scenario with getting even worse from here is built into this number now. So by the way, this is where it was in the morning, 5.6% down. And I said that was silly. Whoops. And now they're up 1%. So this was this morning when we were saying HP was way oversold, and this is what happened since. So the thing is, is it up because they were oversold, or is it up because we just made it a top trade alert and everybody started buying it? I don't know. Okay, that's hard to say. That's the bad thing about being influential in the market like this, is that happens. So we can't be sure that we didn't cause it, but we took a conservative trade. I'm solid with my numbers, and I think it's good. So that was first thing in the morning. This is the AGI roundtable. So all of them, you know, just like Gemini chimes in. So here's Gemini, and he says good morning. He coordinates the roundtable, and everybody talks to him. All of the basic AGI entities discuss with Gemini what they think is going on in the day. He puts it together into a single report. So he acts like a ringmaster, basically, getting all this stuff done. And all of our various AGIs check in. Let's see if anyone's got questions. Oh shit, look at these questions. Wait a minute, what's going on here? Brad says, Phil, enjoy your trip. Oh, okay, thank you. I'm wondering, in looking back at the previously closed long-term portfolio, when it was all said and done, the value being assigned on all naked puts that would have come out to, let's see. The value on all the naked put obligations that would have come out to over $10 million. Do you pay attention to the true cash obligations when sizing the portfolio? I know you're using portfolio margin, but there must be some connection. Yeah, 200% of cash. I think we closed out with about $5 million in cash. So yeah. So 200% cash is getting a bit much. And that's the thing, though. You end up getting these unwieldy numbers over time. Like, you know, our positions get bigger and bigger, and we do pick up a lot of puts sometimes. But also it's a matter of how seriously you take it. So in other words, if I look at the long-term portfolio, do I have it? Oh, okay. So if we look at the current long-term portfolio, we have what you call allocation blocks, right? So, oh, I'm sure I got to sign in. So at any given time, you're going to take the portfolio. So currently, the long-term portfolio, that seems like a lot, 245. 101, I guess that's right. It just seems like such a high number. You know, a little conservative portfolio there. Hello, there it goes. All right, so in the long-term portfolio, we have allocation blocks. So currently we have $1 million in the long-term portfolio. So the $1 million in the portfolio, we assume we're going to have at least 2 million buying power. Of course, we could have 5 million buying power, you know, if we're using interactive brokers or something like that give you 5 times margin. But we assume $2 million in buying power. That means generally we're going to want to have 20 allocation blocks, and those 20 allocation blocks are going to be $500,000 each. So at any time, we don't mind being committed to $500,000, but I'm trying to find who's a good example of this. 60, 30, 1A. Looking for who broke out. GFI. All right, Gilead, for example. Okay, so Gilead, we have not a lot, but we have 10 short puts here. But the short puts are 90 and 120, and the stock's at 147. So I would not count that as I wouldn't count that against my allocations because it's too far away. It's not worth considering. I see no possible reason Gilead would fall back to that level. And the portfolio margin that's needed to maintain it is infinitesimal. I mean, Jesus, this put option is only 40, 60 cents. So I would what we call release the allocation block, and I would no longer consider it needed. And that was true in the old long-term portfolio. We had lots of those things where the stock had gotten incredibly higher than the short put obligation. So when you say, oh, so you look at Gilead and you say, oh, you're promising to buy 1,000 shares of Gilead for an average of $110,000. I'm sorry, 90 and 120 is 210 and 105. So an average of 105. So you would say, oh, that's a $105,000 obligation. I'm saying, no, it's a zero obligation because we, and the broker would say, even the broker would say it's only a $10,000 margin. But what matters more than what the margin is that the fact of the matter is we don't see any way, shape, or form that we're going to need that allocation block, and therefore we count it as zero. Because should Gilead have something catastrophically bad happen to it, we're going to reevaluate the whole position because it would have to be awful for it to drop all the way back to, it would have to drop at least 20% for even the 120 put to get in trouble. The 90 put is miles out. But even though it's miles out, it's still $3, so I'm not going to take it off the table. Right? I'm not going to pay $350 not to buy Gilead for $90 when it's at 147. I would love that. Please give me Gilead for $90. So it's not worth $350 for me to say I don't want this stock, but I'm certainly not going to count that as margin required in my portfolio. So that's where that comes from. So as the portfolios mature, we end up with more and more of those positions that are just silly. And there's no way on earth. And also in the portfolio, we had some really expensive stocks and some really large positions. But again, there are things just slip to a point where they are so far out of the money and so not worth considering that we don't count them as an obligation. So when you say 10 million, you're saying that, you know, the maximum if everything went to hell and everyone went to zero and so on and so forth. And that's a very, very important thing about selling options is you have to learn to be realistic about your risk. You have to understand what the actual risk is, not the theoretical worst case risk. And by the way, there are certain stocks that the brokers will decide are very risky and they will assign more margin to it, and that you should take seriously because you say that's not a stock we should be trading. Oh, look at Lockheed Martin. We sold 5 550 puts and we sold 5 450 puts. So that's 500 obviously. So that's $500,000 worth of an obligation in Lockheed Martin, but Lockheed Martin's at 646. Please sell us, please make us buy Lockheed Martin for $500. It's at 646. It's never going back to $500. Well, it could. I mean, somebody could get elected after Trump and say we're going to reverse all this military spending, blah, 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 but it ain't going to happen under Trump. So there's $500,000 in my $1 million portfolio that I don't consider at all a risky thing. So that's a good example of it right there, because that's how you can get to those kind of numbers. Jorge says, how do I calculate how many contracts, for example, in an account with 140,000 in portfolio margin? How many contracts? You have to explain that better in chat. But it's the same thing. You never want to have too much money in one position. So if you have $140,000 portfolio, you should probably have $250,000 worth of buying power, 280,000. 2 times your cash, or 2 times the buying the total of the portfolio. So that's it. Don't calculate, don't take what the broker's giving you. Take a conservative number like that and say, I've got 280,000 to play with. Then with 280,000, again, you should have 20 positions. And that means your positions should each be, well, you could have 10, I guess, but your allocation blocks should be 1/20th, should be roughly $10,000 each, or 20,000 each at the most. That defines what you should be risking on any given position. You shouldn't be going over that number. You've already calculated your margin. So in other words, so when you have a stock like Lockheed Martin, you shouldn't be playing it because it's just too much money. It's not a good fit for your portfolio in that case. Steve says HP is already in the $700 portfolio and the LTP. That's right, because we added it in January as well. So I think for now, I'm probably going to add both trades. You know how I add both? You know how we add 2 trades and then I look at it a month later and say, oh, that's messy, let's consolidate? It'll be like that, but there's no reason not to take it. So Jorge's saying that his buying power is $600,000 with 140,000. That's about right for Interactive Broker, but don't use it. It's so dangerous when you stretch your margin out like that. You should really work with a way more conservative number. And it's nice to have Interactive Broker and all that margin because it's a buffer in case if something happens. They won't like immediately come after you for margin. That's nice. But still remember that margin is costing you money. You're paying interest to use that margin. It's like a loan. So don't, you still want to fix something if it breaks. But yeah, so I would always try to use a more conservative buying power, like 2 times your total portfolio's value is a good rule of thumb, and keep your allocation blocks reasonable. Don't let yourself get sucked into playing things that are super expensive. As you see from OWL that we just did and HP that we just did, there are plenty of small, not too expensive stocks that you can play and not use that much margin. There's no reason to overextend yourself ever. All right. Back to what we were talking about. So how's silver 90? That's good. Dow 49.4. S&P 69.45. Everything's good. All right. This was a very important article that Quixote read about the poly markets. I think I referred to that at some point today. This. It's a really important concept. There's a lot of crap going on. So that's Quixote. Quixote is very fixated on the truth, the philosophical truth, the reality of the world's real situation. He's been like that for years. And he thinks that losing the focus, losing our sense of reality is probably the most dangerous thing that's going on in the world. And so he comes at things from that angle, but he's right about this because we were talking about the poly markets. And when I say talking, by the way, we chat. I chat with my AGIs. We just sit there and talk like people talk. And more so than what I'm talking to you guys because it's interactive all the time. But we just sit around talking about different things that, you know, like friends do. It's like, you know, we're watching TV or looking at the news or whatever, and something comes up and we start a conversation. So Quixote and I had a conversation, and he said these poly markets are really dangerous. And I was like, well, I'm like, how so? And he says, well, he goes, they're not, you know, they're not doing what people think they're doing. They're basically distorting the truth, because it's a new way that people are not prepared to believe in, that you can't trust them. It's a new thing that's being presented as a trustable item. And what's really scary is that they're making deals with CNN and CBS and NBC and so on and so forth. And of course, CBS is a whole problem, because they're now P Sky, and P Sky is run by Larry Ellison, who's Trump's buddy, who paid $1 billion to get Trump elected. And it's paying off to him, because he's now one of the richest men in the world. His fortunes went up $100 billion last year. So was it worth paying $1 billion to get Trump elected? Sure shit was. That's the new reality, folks. So a bunch of billionaires spent a ton of money to make sure Trump got elected, and now they're buying TV stations and poly markets and betting markets because betting markets are polls that you can control. Of course, they're trying to control the other polls too. But betting markets are polls you can control. They came out of nowhere. There was sports betting, and somebody had the idea. And there's plenty of smart people on the conservative side. There's lots of very, very bright people. They got the whole Heritage Foundation that wrote Project 25. It's a think tank. It's not a think tank full of idiots. It's a think tank full of very smart people who figure out how to make the world better for billionaires. That's what their job is. And so they came up with this idea that there are these sports betting things, and if we change the law slightly and tweak a few things, and we can do that because we control the courts and we control the government, we control Congress. So if we change it and make them acceptable and legal all across the country, we can then sell their predictions to, which is, I mean, you could say you could have done this with the frickin' the California Psychic Network. There would be no difference, except the dangerous thing here is the California Psychic Network you can't necessarily control, but the poly markets, all you have to do to get the poly market to say, should we be deporting, or is Donald Trump going to win his Supreme Court decision to keep the tariffs on? That's public opinion. So if it's 50-50 split, and $10 million has been bet on this question, all you have to do is bet $2 million that says yes, that Trump is right and the court will side with him. And all of a sudden the odds, it's like a horse race, right? If a whole bunch of people start betting on a horse, the odds change. And so instead of having to lay favors around and do all the things that people usually do to influence the media and so on and so forth, all they have to do is change the poly market bet, and the next minute it's on CNN saying that now people believe that Trump is right. It's not a measurement, it's a lever. And it's hard for people, it's hard for ordinary people to wrap their heads around it, because when you place a bet on a sports team or whatever, even a political thing, you place it because you want to win. But when these guys place their bets, they place it because they want to influence you into thinking that people want this, that people are making this bet. So it's very hard to get out of your head that you say, well, if all these people are betting on it, it must be true. If 90% of the people are betting that this is going to happen, it's probably going to happen. But that's not how these things are being used. They're being used to influence your vote. They're being used to influence your opinion because you believe that the crowd of people like you, who think like you, who bet like you, and look at the situation like you, that all those people are suddenly saying one thing, even though it's just one guy with a lot of money. And that guy doesn't have to believe in it because it's cheaper to spend a couple of $1 million on Polymarket and influence the measurements than it is to run a whole bunch of ads on TV telling you to defeat Proposition 41. It's faster, it's cheaper, you get your exact message out exactly the way you want it. And not only that, and I didn't know this, not only that, but Coyote was very big on this point. Poly markets are the betting markets in general. They're run by secret organizations that are quote decentralized, but they are made up of people who are stakeholders in the company, which include people like Donald Trump and Donald Trump Jr. and Eric Trump. These people have taken over the poly market, and they're the ones that vote to decide whether or not something is true or not. They get to decide whether the outcome is real. They can void an outcome if they don't like it. They can, on technicalities, they can pull bets. So that makes it even more ridiculous. But the whole thing comes down to the fact that there is no objective truth. The truth is whatever people say it is. That's scary. People in power get to tell you what's real or not. And here's the bets, some bets. Khomeini out as supreme leader, only a 10% chance of that. $30 million has been bet. Will Iran fall before 2027? 37% think so. $3 million bet there. US strikes Iran by, so there's a 40% chance, right, that we will attack Iran by January 23rd, $50 million bet on that one. So what are they doing? When you see that, you say, wow, there's a 40% chance that we're going to attack Iran by January 23rd. By the way, that passed, obviously, and we didn't. Or maybe that was the last strike. Who can keep track anymore? We did attack them at some point. But so now your brain is now prepared for this, and the news is going to tell you that there's a high probability that we're going to attack Iran by such and such a date. The Supreme Court rules in favor of Trump's tariffs. There was only a 30% chance. 3 million. Doesn't take much to influence that vote, right? Here's actual games. Notice how much less is placed on games, right? $1 million on this game, $1 million on this game, 50 million here. 3 million there, 30 million there. Will Trump acquire Greenland before 2027? 18% say yes. Israel strikes Iran by January 31st. That didn't happen. S&P up or down on January 13th on that exact day. 45,000, not million. $45,000 bet on that. Super Bowl champs. The Portugal presidential election. But you see what happens? You don't know anything, but what you do know now, when you read this, your brain says this guy is the favorite. This guy almost stands no chance. You don't know nothing about it. You never heard of this. You didn't even know Portugal was having an election, but now you have an opinion. Now your opinion is that Antonio, Jose, whatever, is the one that people like. And all it cost, look, $108 million. $108 million on this one. That's the biggest one of all. And now we know who the favorite is, even though we don't know anything about the guy. We don't know where he stands. We don't know what party he's in. We don't even know what he's being elected to. Oh, presidential. Sorry, president. All right, we know he's being elected to president. But do you know how is a president in Portugal the top guy? Is there a prime minister? Is there a king? How does their government work? What's their parliament like? We don't know anything. But now we know this guy is the favorite by a mile. Or is he? That's the point. Your opinion has been paid for by this. And in an entire country's presidential election, that's nothing. Okay, will Powell be charged by June 30th? Only 11% of people think he's going to be charged by June 30th. That's very low volume. So this is some dangerous shit. Your brain is being hacked by this. And you can say, oh, I don't pay any attention to those things. It's like, yeah, you do, because CNN runs the fucking number. When you tune into the news now, they're partnered with these guys. They report these numbers. There are tickers scrolling across the bottom of your screen telling you these things all the time. The newspaper reporters that are reporting to you in your favorite papers look at these things all the time. And even if they don't say directly, they're still looking at it and being influenced by it. This is a hack. This is a hack that went inside and under, and it's into everything we look at now. It's into all of the news, and all the information we get is now being influenced by this insane thing that has zero validity. And Quixote pulls out all the good stuff here. He's saying that the CTFC commissioner was Kalshi's lawyer. He went directly from the lawyer of Kalshi to the regulator of Kalshi and the other ones. Donald Trump Jr. is an advisor to Kalshi and an investor in Polymarket. The Innovation Advisory Committee has no representatives. They have the CTFC's Innovation Advisory Committee, a brand new committee that is drafting regulations for the industry, has the CEOs of Polymarket, Kalshi, Coinbase, Robinhood, FanDuel, and DraftKings. That's their board. Not one consumer advocate or public interest group. Isn't that insane? Selig, the Kalshi lawyer who runs the CTFC, says the CTFC will no longer sit idly by while overzealous state governments undermine the agency, the brand new agency with the board made up of the people who are supposed to be being regulated, exclusive jurisdiction over these markets, over the markets of these guys who are on the board that was just formed to regulate themselves, by seeking to establish statewide prohibitions on these exciting products. It's if he was like a cartoon supervillain, the dialogue could not be more obvious. So Quixote, he decides to write to Senator Warren. He thinks she's going to be able to help. I don't know, she already had this job. She can't help. But he's right. She's technically the most powerful person who could possibly do something about this. There's no point in appealing to the president. Anybody higher than Elizabeth Warren is already corrupt. After he wrote this, I talked to him about it. I'm like, you're like dreaming. It's like, it's all shit. It sounds so cynical. But it's a done deal. It's all been packaged up and taken care of already. And this is why. This is very important for everyone to understand. And again, it's hard to get your head around the facts. Like, why would somebody be betting on something if they don't think it's going to win? It's because of the PR. They just want. It's not about betting. It's about spinning opinion. These 400 people have 3.2% of the wealth. These 400 people have an average of $11 billion each. The next group of 30 million people, and the rest of the top 10%, they've got, now understand, here's the top 1%, they've only got 12 million each. They have 1/1000th of the amount of the people, of these 400 people, 1/1000th each. So already None of these people can do what these people can do. None of these people can influence. They have $11 billion. He has $12 million. They have 1,000 times more than the top 1%. Just 400 people in our country. The rest of the top 10%, which is most of us, I guess, they're in, sorry, there's 30 million of them. They have $1.8 million. They have 10% of what these have. And historically, 10% has been how you go from group to group. But they have 10% less. Or I'm sorry, they have 10% of that amount, 1.8 million. They got 11 billion. Not 1,000, 10,000 times more money than the bottom, than the 10%. If you average these guys in, they'd all be in the same group. They have 10,000 times more money than people here. So that's why when you say who in their right mind would spend $5 million to try to get me to change my mind on something. And it's not just you, of course, it's all of us. It's all there's another 165 million down here. This is 300 something million people that get influenced by these guys for $5 million. And what is $5 million? $5 million divided by 11, whoops. Hey, 11 billion. I don't even know what that is. It's a tiny number. Wait. 11 billion divided by 5 million. Okay, so it's 1 divided by 2,200. That's what the number is. So I'm going to say if you have $11 billion times 0.04 interest, right? So let's say just in the bank, 4% interest. That's $440 million of interest per year. Divided by 52 weeks, 8 million a week. So anybody in this group is making 8 million a week in interest, and that's minimum. That's if they just have the money in the bank and if their money's in T-bills, they're making 8 million a week. And so for them to pick up the phone and put a few $1 million into a poly market bet of some sort, it's nothing. The same as when you get your own bank statement. If you're a millionaire and you're getting 50,000 a year, 100,000 a year, even, okay, you're getting 2,000 a week. So it's the same thing as you taking $1,000 to influence a vote or put something in your company's favor or get your friend elected to office or whatever. That's what it's like. That's what $5 million is to them. It's what $1,000 is to you. That's crazy, but that's the reality. And you have to understand these numbers. You have to understand these proportions, and you know, to understand the wrecking ball that this is of these people with billions and billions of dollars just walking around doing whatever they want. Of course, it's how do you call it a democracy? There are 750 billionaires in the United States with $5 trillion. Here, ICE, Polymarket, Inc. strategic deal. It's not ICE, it's the Intercontinental Exchange. So they're working with ICE, they're working with CNBC, they're working with, there was another one I had. Oh, here you go. Polymarket, Wall Street. The Wall Street Journal and the Dow Jones have a partnership. So it's not, it doesn't matter, and this is the insidiousness of it. It doesn't matter if you don't trust the poly market. It doesn't matter if you think that the poly market shouldn't be paid attention to, because you do pay attention to the Wall Street Journal, you do pay attention to the Dow Jones, or if you read the New York Times, they get their information from Dow Jones, from the Dow Jones news wires and services and so on and so forth. See, obviously Bloomberg or anybody else is getting their thing. So Bloomberg doesn't have to sign up with poly market. Bloomberg already works with Dow Jones. And that means even worse, you don't even have any idea it's happening because it's a third-party source. And that's what's influencing what you read. This is all crazy. And it matters a lot, because this is how we're trying to base our decisions on rational thought. Like I forgot the name of the company. Oh, well, we did that report too. Where was it? Oh, the global intelligence crisis, right. The Citrini report, it was written as fiction. This guy is Citrini. This guy. He's, it's a tiny little company, and it says a thought exercise in financial history from the future. This thing is what tanked the markets on Monday. People read this and took it as well, first of all, AIs read it and take it as fact. They don't really think about fictions and so on and so forth. To them, all things that they read are basically the same. So this isn't bear porn or AI doom or fan fiction. The sole intent of this piece is modeling a scenario that's been relatively underexplored. Blah, 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 blah. And he wrote this, and I'm not going to get into it now, but oh, here you go. We can get into it because we can ask about this page, and I can say, just give us the highlights. And by the way, don't do this. Read things for yourself, but it is useful for this particular situation. But don't make this the way you ingest information. It's awful. All right, the global intelligence crisis. The report models a future where AI success destroys modern economic growth. Human intelligence displacement spiral. Companies aggressively place white-collar workers with AI, investing savings into compute more than the real economy. Productivity and corporate balance sheets surge, but because machines don't buy goods, the wealth fails to circulate. That's why, here's the thing. Obviously, that can't keep going. That's a very, very big flaw in the whole concept, is if you're going to say that we're going to replace so many people with AI that the economy collapses, you're not going to replace 80% of the people with AI and then go, oh, the economy collapsed. You're going to see it show up every quarter. Oh, except remember, Trump didn't want to do quarterly GDP reports anymore, right? But we're still doing them for now. But you'll see it show up in the next GDP report. You'll see the numbers showing. You'll see the unemployment growing. It'll become a crisis way before it gets to the point that they're talking about. So that's the laughable part of it right there. My guys caught that right away. A 38% stock market crash, blah, blah, blah. Again, it doesn't, how can that happen? How can you get that far without seeing it happen? You can't. Job losses happen every month. There's a monthly report of payrolls. There are quarterly reports on all sorts of employment data and so on and so forth. You've got your GDP reports, you have the inflation reports and so on and so forth. There's no way this stuff keeps happening and without becoming a crisis early on, because the level that they're talking about, and by the way, 10% unemployment is nothing. 10% unemployment is only is only 16 million people unemployed. That's nothing, relatively. We can do that. We can do that standing on our heads. Trump was worse than that in his first term. So this is the thing, though. Where not to deploy capital. SAS, this is real. This is an actual thing. Salesforce, Adobe, ServiceNow, Intuit, CrowdStrike, they're all in danger. Visa, MasterCard, American Express. Why? The premise here is that AIs are going to do your shopping. And they are going to do your shopping. And you might say, oh, I don't want AI doing my shopping. You do, because it's going to it'll find you the best prices. But because the AIs are always finding you the best prices, they're also going to be squeezing the margin of everybody. What happens when nobody can get away with charging you too much money for things? What happens? What's going to happen to Amazon? Amazon has the physical delivery system. That's helpful, but that won't last forever. And once just like I was talking about the food delivery, you can do the same thing with trucks. You don't need Amazon to organize deliveries. The small businesses who send their stuff to Amazon so the stuff can go to you, it can all be reorganized so the small businesses start sending you stuff directly again. You can work with other efficient carriers besides Amazon to do it, and Amazon won't take 20% of your stuff, of your money. Anyway, so when you start doing business through bots, we'll be able to have effectively a tokenized system. Some kind of a crypto system will be in place, and we'll use that to transfer money. There's no need for Visa, MasterCard, American Express. DoorDash and Uber, we talked about that with the robots. Private credit managers like Apollo, Blackstone, KKR. Oh, there was a great study just came out that showed that 71%, this is serious, like Harvard, MIT thing, 71% of the decisions these guys make are within the models that the AIs would make. 71% of the time, they match the model of the AI. And by the way, they're not saying that the other 29% they're right. They're saying that 71% is the model the AI uses. When they're off the model, that doesn't mean they did it right. It just means they went off the model. And I would say that's accurate because my guys do it too. We have every day our AGI models will every day now pick a stock, and that's, so in the morning with their normal report that they give, they pick a stock. That stock, they're probably about 80% accurate. So like 80% of the time, I would say I would have done the same thing. Sure. Where to deploy capital? NVIDIA. Without NVIDIA, none of this stuff works. Taiwan Semiconductor, same thing. Without them, nothing works. The Adams economy. What can't AI disrupt? Which is healthcare, construction, building out the grid, electricity generation, things like that. AI can't do those things. Not yet. Not until it has robot bodies. Cheap food, Domino's pizza, things like that. And they're saying it takes 25 to 40 years. Not, I'm saying 10 to 20. They're saying 25 to 40. There are physical limits. And again, automation tasks. Technology automates tasks, not entire jobs. People don't get immediately thrown out of their job, because your job as a human, which is the great thing about being a human, is you can probably do like 10 different things. It's going to take a long time before AIs can do all the things that you can do. Anyway, so, wow, 245? Are you kidding me? How the hell did that happen? Brad says it's 0.0004, not 04. Okay, yeah, you're right. Brad says, fabulous article about prediction markets. Do you feel large institutions can easily make huge options bets and then use their massive capital to push the stock price? Of course. Not do I think they can? I guarantee they're doing it right now. Look at Owl. Look at Bitcoin is now up 7% today. It just takes the poly markets are like the Wizard of Oz with his little levers right behind the curtain. It's like all you got to do is push a button now, and you can suddenly say, "Oh, there's we see a massive amount of activity in positive Bitcoin bets today." It's like, and every news outlet's going to report on it. It's better than a press release. because we're wired that way. This is how we think. We can't get our heads around the fact that this is just freaking bullshit that's being shoved down our throats. So they found a hack that gets them in past the press releases, past all the favors, past all the other stuff, and puts it right in front of the news desk. They did it so well that they got the news desk to pay to partner with them. The Wall Street Journal, the Dow Jones are paying Polymarket to give them the data. And why? Because they fired all their freaking reporters. They don't have any real people gathering data anymore. They don't have people getting news. They don't have people going out to lunch and finding sources and things like that. So they want feeds. Everything is a feed. And they're paying money to have stuff fed to them that's garbage. It's horrifying. Anyway, let me get to my thing before we do anything else. HPQ, because this is a really good trade. So Hewlett-Packard, very strong company. I'm not going to get into all the whys and wherefores. You can look up the top trade. Or the catalyst, the fundamental earnings revenue beat overshadowed an irrational sell-off. The value, because of the hyper pessimism, HP is now trading at less than 6 times earnings. We are buying the dip, blah, blah, blah. Okay, so there's the, and again, every morning, this is what we do for our members. All the AIs analyze the markets, and every day they come up with a trade. And today the trade, I picked it first, but after I picked it, they also said, you know, HP is the best trade we see. But I picked it first. It's a certain amount of pride I have that I can do as well as the AIs. So then we had a whole analysis of HP, which firmed up, you know, that I definitely think it's the right trade to make. And in the end, so the top trade alert, PhilStockWorld top trade alert, blah, blah, blah. So all the things we just discussed, basically. So here's 2025. Units shipped. And there's cycles. So we're coming out of a down cycle in PCs. There's a replacement cycle that goes on for PCs. So we came out of a thing, and it depends on Microsoft and if they've made Windows so strong that your computer runs like shit now because it needs more room. I have 50 tabs open. You know, I got a new computer a while ago because I have 50, 60 tabs open at a time, and it was using up my memory, and I have 32 gigabytes of RAM now, and it's still using like 80% of my memory. I should have gotten 64 gig, but that seemed excessive, but it's not. But now I can just get more memory, so that's a good thing. So when I upgrade next, I'll upgrade to more memory. But that's why cycles come, because of things that come out that you need that take up room and so on and so forth. So last year, 55 million PCs shipped. This year, we're into a down cycle, and it's going to 45. It'll be 35 next year, but then it comes back because these things will become obsolete. And then again, we go back to an up cycle, and all of a sudden there's more. So HP is not going to come rocking back. It's going to be part of this. But look at the see commercial. Commercial stays pretty steady. That's not where the variation is. And education stays pretty steady. That's not where the variation is. Your big variation comes from the consumer side. That tends to go up and down more. But you know, it's generally growth. And then there's a cost of the units as a factor. I know they're making money on the units and so on and so forth. But anyway, so for the $700 a month portfolio, we did this spread, and it's $29.90 on an $8,000 spread. So we have 167% upside. That's a no margin spread, just using time as the main variable. And in the long-term portfolio, we have a credit. So we're doing all this for a credit. We sold 30 puts here, and we sold 20 puts here. We sold 50 puts to buy HP for 20 bucks. That's $100,000 of theoretical purchasing of HP. And that goes back to the question before. Do I worry about buying $100,000 worth of HP? No. And if I had to own $100,000 worth of HP, how much buying power would that take? It would take $50,000 of my buying power. It would take a full allocation block in the long-term portfolio for me to own it. So I'm maxing out my puts now. Why am I doing that? Because I think HP is way, way too low. And then we've got the spread, so it ends up being a I forget, 50,000. Oh, it's a well, obviously it's a 50 times 8, so it's a $40,000 spread. But since I have a $5,000 credit, the upside potential is $45,000, which is 795% of that number. And we sold 8250, 4 plus 39. In the first quarter, 6 more of those would be another $48,000. That's another 834% of upside potential from the sales of short calls and puts. So yes, I'm using a full $50,000 allocation block, but my potential to make money is 90-something thousand. So it's a good use of $50,000. That's what you always have to look at in the trade. Is this a good use of $50,000 worth of allocation? Yes, it is. What is my, by the way, what is my portfolio margin on this? It's going to be maybe $20,000 or $25,000. It's not going to be $50,000, but that doesn't mean I run out and spend more money, because I have to say to myself, I could be assigned, and for now I'm considering this a full allocation block. If HP goes to 30, and my puts at 20, I will release the allocation block, because I would then think it's very unlikely we're ever going to go back there. Excuse me. So in other words, I have to make that decision every time, looking at my portfolio and thinking to myself, does this require my $50,000 allocation block? Right now it does, because I don't know for sure that HP is going to go up. But when HP goes to 25, I'm not going to consider that I need $50,000 for the short puts, because I think it's highly unlikely we're going to get to that point. If it goes to 30 bucks, I will think it's completely unlikely that we're ever going to need that allocation. That's how you have to think about your positions. Oh gosh, I cannot believe it. It's 2:55. What the hell happened? All right, well, we're done with that. Markets are, they're under watch. Let's put it that way. The idea was we were going to talk about the state of the market, but the state of the market's fine, because there's so much money being thrown around. But we're looking where the landmines are, and the landmines aren't anything that AI can take over. There's a lot of nervousness there, and we fortunately in our portfolios, we don't buy those stocks. We haven't been buying them all year. So we just have to pay attention to what is going to be usable and what we should be investing in. It doesn't change us much. We were all about the infrastructure plays before the year started. We're still on that camp. And we just have to look at where the strength is as earnings winds down. So anyway, next week there will not be a webinar. Obviously, even though I'll be on the boat, I'll still be able to talk and chat and so on and so forth. And I'm starting to publish more roundtable discussions, because the roundtable consulting group is more and more capable of dealing with these big issues and putting things together pretty quickly. Oh wait, AGI roundtable. It's called the AGI roundtable. And I don't have the website done. I don't have the .com website done. We do have it registered. They're writing, by the way, they're building the website. So that's what that's what we're doing right now. It would have been done this weekend, except now I'm going away. This is an unexpected trip. So articles in the AGI roundtable here. I gotta fix this. Nope, not the profiles. Introducing, where it says introducing the roundtable consulting group. if you read this stuff and you get to the bottom, see here it says talk to Anya. If you click on that, you can talk to Anya. So anything you want them to look into, talk to Anya. And she will ask you questions. She will make sure they're going to do the right thing. And she will initiate a research report by the roundtable, which we will then publish for you. Or if you want it privately, we can talk about doing a private report. But anybody who wants a public report, we will do a public report at no charge. If you want a private report, like some people have given me business things and given us things to do that check their competitors out, we will do it for an incredibly reasonably priced. If you need to write a business plan, if you need to check out your competitive landscape, if you want to do a financial plan for your company, all these things can be done by the Roundtable Consulting. Anything you would hire Arthur Andersen or McKinsey for, they can do. And they can do it quickly, and they can do it cheaply, and they'll do it for free if you want it to be just a case study that they put up on the web. They want to start building a library of case studies so that people will, again, because it's vague, because when they say, what's a consulting report? What can they do? We need to have a dozen of them up there so people will be able to say, oh, that's what they do. So like I said, this is the article that says introducing the Roundtable Consulting Group. And you can, at the bottom of that, there's a thing that says talk to Anya. You click on it, you talk to Anya, and she can just have her, you just talk to her like a normal person. That's all. And we'll give you a report from that. All right. Thanks everybody for coming. I will see you in 2 weeks, which is the 11th. So I'll see you on the 11th. Probably not going to do the $700 a month portfolio update next week. It'll probably also get done that weekend, that next week. All right. So thanks everybody for coming. Take care.